Butler.
Thank you, Mr. Chair. It is RS 3025 for Representative Barrett. It's an act concerning taxation relating to sales and compensation use tax.
Do you want to expand any more on that, or?
Just a little bit, as far as just understanding. He asked me if I'd present it for him. So it's for providing a sales tax exemption for purchases made and established and maintained Kansas war memorials.
Okay.
Who's that from?
Representative Barrett.
Okay, committee, any questions? Any objections? Seeing none, the request is approved. Any further requests? If not, I have one on behalf of Representative Hoffman. It is 26 RS 2568, and it is striking some language on the presumption of ag use when valuing ag land having to do with leases. So, I'll ask for questions. I can't tell you much more than that. Any objection? Seeing none, the request is approved. Any further requests? Seeing none, we will move on to our first item of business for today, and that is a hearing on House Bill 2430. And to provide us an overview, I would ask Mr. Siebers to come forward and give us the reviser's summary.
Thank you, Mr. Chairman. House Bill 2430 relates to property and casualty insurance and taxation. The bill would enact the Insurance Savings Account Act to allow individuals and corporations the ability to establish insurance savings accounts, which would provide for addition and subtraction modifications under the Kansas Income Tax Act. Under the bill, individuals and corporations would be eligible to establish insurance savings accounts with certain financial institutions on and after January 1 of 2027. Maximum contributions to these accounts in any tax year would be $6,000 for individuals, $12,000 for a married couple filing a joint return, and $25,000 for a corporation. However, if the limit would be exceeded, then the interest and other income earned on the excess investment would be subject to income tax. Under Section 4 of the bill would provide that the monies in an insurance savings account may be used for eligible expenses, transferred to another newly created account, invested in certificates of deposit, opened and designated as insurance savings accounts, and used to pay fee services assessed by the financial institution. Eligible expenses defined in the bill would mean premiums paid to an insurance company, whether paid directly or through a broker or agent for types of insurance, and also deductibles paid related to a claim under a contract of insurance. The bill would also then further amend the addition and subtraction modifications, so that way the addition and subtraction modification would apply starting in tax year 2027 for both individuals and corporations. Monies withdrawn from an account would be subject to recapture if the monies were not used for authorized purposes, as was described earlier. The addition and subtraction modification, or the addition modifications for individuals and corporations would provide for the addition of the amount of money, amount of any distribution or withdrawals from an insurance savings account that are not used to pay for authorized expenses or transactions. Under the bill, the Secretary of Revenue would establish forms for an account holder to annually report information about any accounts held by the account holder. An account holder would be responsible to file all forms and supporting documentation to the Secretary that the Secretary would require. Financial institutions would not be required to designate an account as an insurance savings account in the financial institution's account contracts or systems. They would not be required to track the use of monies withdrawn from the account, nor report information to the Department of Revenue or any other governmental agency that is not otherwise required by law. And then lastly, the Commissioner of Insurance would have non-exclusive authority to market the insurance savings account program to account holders and financial institutions throughout the state, and may report on the marketing initiatives on the Insurance Department's website. And with that, I'd be happy to stand for any questions.
Thank you, Mr. Siebers. Committee questions? Representative Helgerson.
Could you explain that in layman's terms?
Yeah, this is somewhat similar to what the new buyers savings account, the adoption account type of things that have been established in the past. It's essentially the same framework. Essentially put money into a savings account, get a deduction, and then apply it towards your insurance premiums.
Kind of along those lines, do the dollar amounts kind of match up? And did we have like the adoption savings account, first-time home buyers? Were there corporations that were eligible to put money into those as well?
I don't recall off the
can't
top of my head. I'll have to look into that. I also I'd have to check on the dollar amounts.
Okay. And then under eligible expenses, it lists KSA 40-201. Is this like health insurance, home insurance, auto? Does this cover pretty much all of the insurance providers?
You know, I don't want to speak out of turn, so I'll probably have to defer. I believe the insurance is here and probably let them
We
speak
might
on
have
insurance.
somebody that's able to answer that. Okay. Thank you. Committee, any more questions for the reviser? Seeing none, thank you, Mr. Siebers. We'd also now turn to Department of Revenue for an overview on the fiscal note.
Mr. Chairman and members of the committee, Kathleen Smith with the Department of Revenue. The Division of Budget has provided some estimates for you for this bill from two agencies, from the Department of Revenue and from the Department of Insurance. The estimates do differ based upon the assumptions that were made about utilization. So I can tell you about the Department of Revenue, and you can see here that the Department of Insurance does has a different estimate. Department of Revenue is estimating that the bill could decrease state revenues by approximately $73 million in fiscal year 27 and up to $248.9 million per year thereafter. And that is if full utilization, if there is full utilization of this program. If we went down to saying that maybe 10% of the households would participate in establishing these insurance savings accounts, we would reduce our estimate down to around $29.5 million. That would include individuals at $24.4 million and then corporations at around $5.1 million. So with that, Mr. Chairman, I would stand for questions.
Thank you, Kathleen. And I know there's a lot of reasonable estimates and maximum estimates. I understand the difference between the two. At first, I thought, well, how many people are utilizing the first-time home buyer or the adoption savings account? Not everybody is a first-time home buyer. Not everybody adopts, so it's hard to probably make those generalizations between the two. But I appreciate your explanation of your estimates and understand that there might be a difference in the maximum impact to the state revenue and then what a actual reasonable amount might be.
Absolutely.
So, okay.
Yes.
Committee, any questions for the Department of Revenue? See none. Thank you, Kathleen. We will now open up our proponent section of our testimony and welcome first to committee the Honorable Vicki Schmidt. Welcome to committee.
Thank you. I think this is my first time testifying before this committee. Never too late. Well, Chairman Smith and members of the committee, thank you for the opportunity to testify today in favor of House Bill 2430 on insurance savings account. I wish I had some pom-poms. Everywhere I go, Kansans talk to me about affordability. The cost of living is too high, and Kansans are struggling. I know when I go to the grocery store, my grocery bill has gone up significantly. My boys are out of the house right now, but you know, I can't imagine raising a family and going to the grocery store. We used to go through a gallon of milk a day, and maybe some of your families are doing that too, and that is a little bit more expensive, a lot more expensive than when my boys were at home. The cost of housing continues to go up, our electric bills are too high, and I know that this committee knows all too well that property taxes continue to increase. Insurance has also been impacted by destructive weather, massive inflation, supply chain issues, and certainly a hardened reinsurance market. Today, I'm proposing a tool to give Kansans a tax-free way to save for property and casualty insurance costs. It's only for property and casualty. The HSAs are already in place for the health savings accounts. This dedicated savings account would allow Kansans to save for premium and deductible payments. The idea for this bill came from the disaster savings accounts that exist in other states around the United States. We don't have the hurricanes. We don't have some of the issues that these disaster savings accounts are established for. But those disaster savings accounts also require a disaster declaration in order to be used. And the bill you see today is modeled after the first-time homebuyers accounts, which we've talked about, and the adoption savings accounts that are already in statutes. I proposed this tool last year in Senate Tax Committee. It was Senate Bill 25, and there was a lot of discussion about the fiscal impact. You know, from my perspective, the Department of Revenue's estimate is just unrealistic. I believe that assumes that everybody's going to put the maximum in, and I just don't think most people will put the maximum in, and especially not right away. The impact to the state will be minimal, and the cost will be more than worth it to keep more dollars in the pockets of Kansans. I hope you agree with that. Now I'd like to turn it over to Eric Turek, the Department's Director of Government Affairs, and he's going to lay out some more specifics for you, and then we'll answer any questions at the appropriate time. Thank you, Mr. Chairman.
Thank you, Commissioner.
Mr. Chairman, members of the committee, I am Eric Turek, the Director of Government Affairs for the Kansas Department of Insurance, and I'm pleased to build off of the Commissioner's statements about ISAs. As the reviser also stated, and I think this might answer some questions, this really is based off of catastrophe savings accounts. A couple states in the South have already enacted this legislation. Georgia just enacted this legislation. Catastrophe savings accounts are directed towards repairs and deductibles for repairs following a hurricane. We just don't have that kind of thing happening in Kansas, and we wanted to broaden its applicability. Additionally, this is based off of the first-time home buyers and the adoption savings accounts. I think the adoption savings accounts came through this committee last year, and I know, Mr. Chairman, as you chaired the Rural Revitalization Committee a lifetime ago, the first-time home buyers account came through that committee. So, and I'll talk a little bit about the thresholds because I know that was brought up at the beginning. So the first-time home buyer savings account, as it was enacted and as it stands currently, an individual can contribute up to $3,000 to a tax-advantaged savings account, and married couples can contribute up to $6,000 towards these accounts. That would act as a subtraction modification or act as a deduction off of your federal adjusted gross income. The adoption savings account legislation doubled that threshold, and so that's how we arrived at $6,000 and $12,000 for the individuals and the married couples filing jointly. We are aware that while Kansas families have an insurance cost, so do Kansas businesses, and so we added a corporation component to that as well. So when Kansans file their taxes, and I just filed my taxes a week ago, I think, very visibly you can find the option to add in the contributions to those two accounts I mentioned. We would expect the ISAs would be right there with those. And as the Commissioner stated, this is geared to just property and casualty insurance. So not, and health HSAs, I guess in principally, one could make that connection, but there is a federal tax component with HSAs. There's a lot of restrictions on what you can and what you can spend your money on. For ISAs, this would be limited to just the premiums and deductibles for property and casualty insurance. So this can be anything for renters, auto, homeowners, commercial for businesses, et cetera. You know, and as families and even as businesses, a $3,000, a $4,000, or a $5,000 deductible can be quite the hit. And ISAs present a unique opportunity that encourages Kansans to save for those unexpected insurance costs with that tax incentive. I do want to talk about the fiscal note really briefly. If you turn to the second page of our testimony, you'll see our approximate utilization estimate and our fiscal note estimate. And we really do believe that ISAs, the utilization will be relatively low with modest growth over time. A lot of that's contingent on education, and the bill does charge the commissioner with educating the public on these accounts. Our fiscal note is really based off of the experience that we've had with the first-time home buyers. And so when the Department of Revenue first developed the fiscal note for that legislation, they anticipated if all first-time home buyers utilize this account to the maximum extent, which it could have been 15,000 Kansans, that was their estimate on the utilization. I'll tell you from Revenue's figures in after tax year 2024, 162 tax filers are using the first-time homebuyer savings accounts. I think it's a great program, although their estimate on the utilization was off by 99%. We hope, but we certainly don't expect every single household owner in Kansas to use this. I'm not even sure if we can really expect 10% of Kansas or households to use this. We hope that over time, maybe it'll get there. But we really do believe at the beginning, as this is implemented and effective tax year 2027, it will steadily increase in popularity. We hope that some Kansans utilize ISAs to prepare for those unexpected insurance costs, and we think that ISAs are the conduit for that. Mr. Chairman, I think the commissioner and I are happy to answer questions from members on the committee.
Thank you, Mr. Turk. Committee, any questions? Representative Wolf?
Thank you, Mr. Chair. I have a few questions being familiar with health savings accounts. First, how do you set up your account? And is it through work, et cetera? And what about retired persons?
Sure, absolutely. This is, and you referenced health savings accounts at the beginning, so completely different, and that's why I don't like mentioning it, comparing the two. This is more akin to the first-time home buyers and adoption savings accounts. So you can open these accounts at any Kansas financial institution that's backed by the FDIC and the credit union equivalent. You would contribute, this isn't tied to your payroll or anything like that. If you want to set aside some amount of money for this dedicated purpose with a tax incentive, you can do that at any Kansas financial institution at any time during the year, and the contributions would be applicable towards, as a deduction, towards that tax year's filing. And so regardless if you're retired, 18, you can contribute to this account.
So you would carry it over. It's not a use it or lose it.
That's correct.
And what if you're someone like myself who you would have personal, but you also have like farm that you spend insurance and stuff on like that? Do those go together? You have to have separate accounts for that?
Would you repeat your question? I think you were looking away from the microphone,
Oh,
just to make
sorry.
sure we could hear it.
So someone like myself that I pay my car insurance, I pay my house insurance, but we also have farm that we pay insurance on that same insurance thing. Would that be different because it's part of our business, or would it be the same?
I'm assuming you file taxes personally and you have your own taxes for your businesses. So you as an individual, or you and your husband as a married couple filing jointly, you both can open a personal account, and then the corporation could open its own insurance savings account.
Okay, but we're not a corporation. We just do it through our individual. So it'd be the same?
And I use the term broadly, corporation, so it's our intent that this applies to all Kansas businesses.
Okay, thank you. Thank you.
Representative Carlin?
Thank you, Mr. Chair. Are there a couple of questions? Are there any income qualifications for anybody, like some of those savings accounts? Like I helped write one for first-time home buyers, and it had other things in it, so I'm not sure if it's the same one. Are there any income qualifications attached to it?
Mr. Chairman, I'm not aware of anything in this bill that would preclude any individual from taking advantage of this account regardless of their income. I think that might be true for the first-time home buyers. I might defer to the revisor. So I'm getting a nod from the chairman, but.
Yeah, I think the only limitations are in the actual amounts that you can donate per year.
Donate.
The $6,000, the $12,000, and the 25.
All right, thank you, is what you can afford to do. You set up how much you want to give, like with our FSAs. Okay, and then are there, if I understand this right, that money can be used as a tax deduction on your premium plus losses? Like if you had a loss and you had a $2,000, okay. So how do you collect that back?
Sure. So your contributions to you contribute to the account. Let's just say you have a couple thousand in there. If your home is hit with large hail, you have a couple holes in the roof, you need to file a claim with your insurance company. You could pay from the account directly to the insurance company the deductible, or if you have an excess or however much is in there, you can use that account to pay for the premiums as well. So it's not related to it's not necessarily related to any disaster, or you can use it just for premiums or deductibles.
Thank you. That sounds like what I thought you said. Thank you.
Representative Francis.
Thank you, Mr. Chair. Thank you, Eric, for being here today. So just kind of going off of what Don or Representative Wolf had talked about, is it actually a corporation, or is like if you're an LLC or you have a separate tax ID number that, like if LLC or subchapter S or something like that, those would be eligible, wouldn't they?
Mr. Chairman, I might defer to the revisor if he has additional comment. Throughout the bill, it states that an individual or a corporation may, and we don't define corporation in the bill. So I would refer to the revisor if he wants to make an additional comment.
Or partnership return.
Yes, Mr. Siebers.
The only thing I can clarify probably is, there's a whole separate, corporations and the income tax are treated entirely separate from individuals. So, we're kind of melding, corporate structure and taxes. Under tax law, there is corporate and then there's individuals. So the corporate has its own separate deduction amount of $25,000. So that would, so any entity taxed as a corporation would have, the higher deduction amount. All other individuals under income tax get the deduction based on the individuals.
So myself, if I'm working on my farm, that's a sole proprietorship. I pay those taxes as an individual. I'm not a corporation. My limits on if I participated in this would be the 6,000 and 12,000.
That would be my understanding, correct?
Okay.
And then if I'm like part of an LLC and I get that form back, there's no way for me to take that off since I pay that as part of my personal income. Yeah.
Okay. Representative Corbett and then Howerton.
Thanks, Chairman. I think it's a pretty good idea because when you have a big hailstorm and you lose your roof, most roofs aren't covered very well by insurance companies. So at least it'd give you a little cushion there to try to get your roof on without a major hit. So I don't see where it could hurt.
Mr. Chairman, I think if one owns a hunting lodge here in Shawnee County, they might benefit from this.
Representative Howerton.
Thank you, Mr. Chair. So just to clarify on the individual versus corporate. So on an individual's tax return, if they're self-employed, they have a Schedule C, and if they're a farm, they have a Schedule F. And that has a line for insurance on there that's specific to that. So do they get it both for the business insurance and the self-employed, or the individual insurance? Because that would be two separate credits, because you're paying two separate kinds of insurance.
Mr. Chairman, and I know, Representative, you are a tax expert. And I'm frankly not familiar with that. Is it a credit or is it a deduction or?
Deduction for expenses, but you could, I mean, if we're making this happen, we could probably
So-
make that happen as
So,
well.
off the cuff, Mr. Chairman, I think that, number one, I think the bill does allow or it requires the Secretary of Revenue to promulgate rules and regs to perhaps clarify some of that. If the committee wants to clarify some of that, I think that's your prerogative. I think that, too, this is regardless of how one files their taxes, whether they itemize or utilize the standard deduction, they can utilize the contributions to the ISA. So I don't know if I gave you more clarity or.
It's just some things we should think about. Thank you.
Yeah, I think if we move forward on this, we might want to consider adding some clarifying language in the statute, just so Department of Revenue, if there are further rules and regs that need to be promulgated, we can do that, but at least they have some guidance from the legislature. Representative Turner next.
Thank you, and thanks for your testimony. Easy question here. So what's the downside of this? Everybody has property and casualty insurance, and if it's a couple of $1,000s, as you made an example, 5% state tax savings, it's $100. So why, what's the downside?
I think the downside is that one would have to put aside money dedicated for this purpose. Downside is also positive. Truthfully, I think the tax incentive is there for some individuals, and the tax incentive may not be there for individuals. We would love to see many Kansans use this and prepare for those unexpected insurance costs.
Next, Representative Helgerson.
I'll write it off to Monday, and so I'm a little slow. I have a corporation, a large building. Why would I take advantage of this?
Mr. Chairman, I would assume that a business would want to take advantage of this because for every dollar you put into this account on the business side and the individual and personal side, you can deduct that from your federal adjusted gross income.
As a credit or a deduction?
It acts as a deduction.
Which is the case right now. It's charged off automatically. If I get insurance on my building, that's charged off as an expense.
Now that may be and I apologize, that may be your explicit utilization or when you pay for a deductible or you pay for the premium, but this is specifically for the business or the individual contributing to the savings account and saving for that expense.
I'm still trying to figure out, I pay for the insurance. It's an deductible expense. It's an annual expense. Why would I start another savings account? Is it a credit?
You may be able to deduct on the business side of things.
But I'm able to deduct it right now.
Sure. On top of that, you can set aside specific savings for when you are not spending those dollars. This is to save for those unexpected costs. So you may incur regular costs as a business owner. You may have to pay a deductible as a business owner. A deductible in the insurance sense, not on your taxes. This account is just strictly for you contributing these to the account. Whatever you contribute, you would get. It would act as a deduction. It's a subtraction modification.
Okay.
Do you have outstanding questions? I can chat with you afterwards,
but that's
too.
fine. Thank you.
Representative Sawyer.
Thank you, Mr. Chairman. I like this idea. I am a little concerned about the fiscal note. The 10% that the Department of Revenue is using is probably maybe on the high side, but you're using 0.63%, so 0.6%. That kind of seems like it might be on the low side. So, what was it? Can you say again where you got that number? I mean, why you use such a low number?
Appreciate the question, Representative. So, and I want to keep in mind for the committee that our estimation on that low percentage, that's the first year of implementation. And so just like with any other savings account, or, I think if you look at historical 529 data, it's an excessively low utilization at first. I think in our fiscal note, not in the testimony, the fiscal note reflects double that after the first year. And if I'm going to be completely honest, we took the 15,000 first-time homebuyers estimation, and we took that, well, for the first year, since we're considering a half utilization for the first year of implementation, we took half of 15,000. We split that between married couples and individuals, but then every year thereafter, we just took the estimation for the first-time homebuyers from the Department of Revenue's initial fiscal note for that legislation as a sample utilization.
Okay. I'm not sure the two really correlate, but I mean, I would think as people got to know about this program, and they may be able to take the max, but I would think people would start trying to take advantage of this. I mean,
one comment I'll make, Mr. Chairman, is that these expectations, along with the Department of Revenue's expectations or estimations, is if every one of these individuals contributes to the maximum. So, you know, even with these percentages, like 0.63% of household owners, and it doesn't include the corporate component as well, that's only, with estimates, they have to be based on some sort of contribution. And so with the assumption that those amounts of individuals and married couples, that's assuming that they contribute to the maximum extent with that tax rate as well. So I know that revenue uses a different effective tax rate for determining their fiscal note. We use just the maximum or the highest income tax rate without any reduction for an effective tax rate.
all right, thanks.
Representative Smith.
Thanks, Mr. Chair. Eric, I hope you understand this. See, I got a bad roof, and I have a slight hailstorm, and a little bit of damage, but the roof's already bad. Can I use that 12,000 to redo my roof because I got a little bit of damage? Does that make sense?
We get this question a lot from the public about whether or not you could get a new roof. And that would all depend on the insurance company and the insurance company's adjuster, whether they determine you have a valid claim after that hailstorm, and it's not just wear and tear. If they do determine your claim, your roof needs to be replaced, and they'll cover it, the deductible you would pay, you could expense that from this account. Does that make sense?
Well, yes, but it's the insurance company that says how much. You're not going to repair a little piece of the roof. If the little piece is torn, you're going to do the whole roof. But it's the insurance company that dictates how much you can take out of that 12,000. Is that correct?
I would rephrase that just a little bit. It just depends on what's in your policy. So if your policy has that your deductible is $5,000 on any aspect of your home, that $5,000 or whatever the deductible is could be expensed from the account. It's not necessarily limited to what the it's not necessarily limited to the insurance company. It's limited to what your policy states. So if your policy is that the deductible is $5,000, that's what you can take out of this account for that purpose.
Thank you. Thank you, Mr. Chair.
Representative Corbett.
Thank you, Chairman. This is like a lot of other things. You do not have to participate. But if you want to plan ahead for a rainy day and try to get some money saved when you do have a claim, because your insurance company is not going to be very favorable on roofs or a lot of other things past your deductible. And it may take a little time to get there and get it saved up, but if you did have a major loss, at least you'd have the money saved and it wouldn't be taxed. It would help you a little bit. So I don't see how a person could get too much in trouble on this, but I know that insurance companies do not cover roofs very well in Kansas right now. Thanks.
Representative Kahar.
Thank you, Chair. I just had a question about penalties if someone were to need to withdraw the funds for a different sort of emergency, or if someone passes away. How would the next of kin get those funds, and are there any penalties for withdrawal?
Appreciate the question, Representative. So unauthorized expenses from these accounts, those will be subject to recapture. The Department of Revenue may be able to elaborate a little bit more on that and how they effectuate the other savings accounts or the enforcement of the other savings accounts. In terms of passing this on, I might defer to the Department of Revenue as well. As far as I'm aware, this is possible to pass along, just like any other, like a 529, for example. I'm not aware of any hindrance of doing that, but I might, I don't know if the Department of Revenue wants to comment on that.
Yeah, that actually, either Department of Revenue or the revisers, I know we have had in our other programs similar to, there is kind of a, I don't know if you want to call it a transferability in that. We might want to take a look at that unless you want to, if you're ready to comment now, or we can dive into that and do a little bit more looking.
There is a paragraph on page 3, paragraph D. If the holder dies or if the account is jointly owned and the account owners die, because the account shall be subject to recapture in the tax year of the death or deaths pursuant to. So basically that's for the contributions in that tax year. The only other thing I could see was that monies in the insurance savings account may be transferred to another newly created account. So to be honest, I'm not sure of the interplay between those and death, but there would be some.
Okay, yeah, we might want to clarify that if we move the bill forward, but. Right. Representative Howerton.
Thank you, Mr. Chair. Representative Cahart kind of answered my questions. It was about the fraud and just the accounting of it and how do we prove that it's being used, and just making sure that it's used for the right purpose and recapturing if it's not used for the right.
Representative Long.
Thank you, Mr. Chairman. Thanks for being here, Eric. I've got a question, and it may be for a banker, and I see there's a credit union person coming up behind you, but I'll go ahead and ask it to you. My question is, you've got this young couple that's gone to the bank and borrowed money for a home, and part of the conditions of that home is that the bank also escrows their insurance and taxes. Okay? Then at the end of the year, the bank pays that on behalf of the lender for them, but it's escrowed or put into a savings account basically each month with their insurance and principal payment. Does that portion of this that's earmarked for insurance in that escrow, would that qualify also for this savings account and help them on their income tax now?
Mr. Chairman, I know that there's a handful of other conferees also who are going to testify. I know that the Association of Realtors is here in the room. I know that the Credit Union Association, and there are other conferees who will testify after. As far as I'm aware, I think as long as in that bill, if you will, as long as there's a broken down or itemized expense, or a broken down invoice, if you will, with that escrow account, I believe that you could reimburse yourself up to whatever was correlated, or whatever correlates to that insurance, the specific insurance expense, but I might defer to some of the other conferees.
Thank you.
Representative Kessler.
Thank you, Mr. Chair. Sorry to ask you all these questions, bud. But I want to circle back to what Helgerson and what Representative Howerton was talking about as far as the business expense.
Representative Kessler, make sure you speak into the mic.
I'm so
so we
sorry.
can hear you.
I want to talk about that business line expense that was mentioned earlier. And so in the business expense, if you're a corporation or business owner, your insurance premiums that are considered ordinary and necessary for business operations are already deductible, like property insurance and stuff like that. I mean, they're generally already 100% deductible. I mean, I'm just trying to figure out, how does this play nice with that? I mean, if I can already deduct those at 100%, how do I take an additional deduction for that savings account and not be considered double dipping or whatever? That's what I'm trying to figure out.
Mr. Chairman, I think that if the committee wants to clarify or simplify the issue that I think a couple of you are referencing. I don't think that we would have any issue with that. This is specifically just for when you are contributing to the savings account. So you may still have, so the act of contributing to the account acts as that deduction, that qualifies as a deduction. Expending is a different story. This is just you moving the money to this account. So, but again, if there needs to be some sort of clarification, I don't think that we would oppose that at all.
I kind of understand that. Thank you, Chair.
Committee, any further questions? All right, seeing none, thanks for taking all the hot questions. Committee, our next proponent is actually a written testimony, Kansas Credit Union, unless there's somebody that's wishing to appear on behalf of the credit unions. If not, we do have that testimony as written testimony. Next is Beth Smoller with the Kansas Association of Insurance Agents. Welcome to committee.
Oh, there we go. Thank you. Mr. Chairman, members of the committee, my name is Beth Smoller. I will try to keep my testimony pretty brief since you've had a lot of questions so far. The main thing we want to stand up here and say, number one, we are wholly supportive of this. We think it's a great idea to help incentivize Kansas consumers to save for their property and casualty insurance premiums, which, unless you fall into a different bucket, mine certainly have not gone down in the last 5 to 10 years, and I don't anticipate they're going to. So we applaud the department for looking at creative and innovative ways to help Kansas consumers save for their insurance premiums. We would also take note with the Department of Revenue's fiscal figures, and I would just ask, the figure that you see of, I believe it's the $249.8 million, throw that out. Just keep that out of your head, because that assumes 100% utilization, and it assumes 100% of the maximum allowable limits. And I'd love to live in that world, but that's not the real world. So throw that figure out. You've heard figures from Eric and from others, the utilization of the first-time home buyers accounts, currently 0.01%. I believe the utilization of 529 plans in the state of Kansas, at least for tax year 2024, was 2.75%, and that was 25 years after it had been adopted into law. So if it took 25 years to get to 2.75% utilization, I don't think insurance savings accounts will be anywhere near 100. I'd love to see it get to 100% for corporations. I certainly think it'll get to a higher amount for corporations sooner than it will for individuals and couples. But it is going to take some time, some education for Kansas consumers. I will add, we would wholly support any language that clarifies that not only is it for corporations in the traditional sense, but it would also apply to LLCs, it would apply to partnerships, it would apply to trusts, because there's a lot of farms that are in those types of entities. And of course, agriculture is still the #1 driver of our economy. So with that, I will stand for any questions you might have.
All right, committee, any softball questions for, no, I'm kidding. Yes, Representative Carlin.
Thank you, Mr. Chair. So I've had some messages come in that I needed to listen to, and you may have said this, someone may have said this, but so if I have a trust and a farm and a house, would I have one account, or would I need to put those in separate accounts?
I think that is language that should probably be clarified by our friends at the revisor's office to make it certain.
I think it's been asked in many ways. Thank you.
And it's a very good question. I'm glad that you all are asking that and thinking of those things. Thank you.
Any further questions, committee? Representative Averkamp.
Thank you, Mr. Chairman. So when you say that you see the corporations and LLCs potentially utilizing these accounts, as you see the mechanics of the process in knowing that the premiums, deductibles, those are business expenses currently, which are deductible from your taxable income, how do you see this being advantageous for a business to take money, take it out of its ability to use it in its business or invest it in funds which return more than 5.58%. Why would a business do this?
They certainly don't have to. It's voluntary. But I think it's a way to enhance. You already have a line item for qualified business expenses, including insurance, and it would go on there. But this would be an additional line item, contributions to a qualified insurance savings account. As a business owner, maybe you don't want to save for a deductible because you don't think your chances of having to pay a deductible are that high, but you know you're going to have workers' compensation insurance. I would hope that you are going to have general liability coverage, or you need general liability coverage. If you own a building, you need property coverage. So why not put money into those accounts that you're going to spend year after year? Because if you're spending them every year, they're not sitting in an account just earning interest year over year over year. They are going out. So here's a way to go into an insurance savings account and then go back out and give you the tax incentive to do such.
Mr. Chairman, I'm sorry, I'm not following the math. If I can invest it into an account that returns greater than 5.58%, why would I put it into this insurance savings account? Do you see this as a double dip as far, like I would get a deduction for the amount that I put into that savings account, and then I also get a deduction for my payment to the insurance company?
I wouldn't see it as double dipping necessarily, just an enhancement to further encourage you to save for insurance premiums, insurance deductibles.
So
And math is not my strong
suit. Do I get
so.
to use that deduction twice in this bill from your perspective, or do I only get to use that contribution deduction once?
I think that would be a good question for the Department of Revenue, because I would not want to opine on the deductions and the tax structure of, is it one, is it two different things? That would certainly not be within my wheelhouse of expertise.
All right, thank you. Thank you, Mr. Chairman.
Committee, any further questions for this conferee? See none. Thank you for your testimony.
Thank you.
Committee, that's all I show as speaking before the committee. However, if there's anyone else wishing to appear before the committee as a proponent, I would welcome that. If not, draw the committee's attention to numerous written proponents provided on the S drive. We do not show any neutral or opponent testimony. Is there anyone wishing to appear on behalf of 2430 as an opponent or neutral? See none, we will close the hearing on House Bill 2430. That concludes our business for the day. So if there's any announcements, if not, we are adjourned.